Well, hello, everyone. Welcome, welcome, welcome. We're so excited that you all came because we have amazing Harlan Acola with us today. He is going to speak to us about how you can borrow money against your home, reverse mortgages, and we'll have a lot of questions about reverse mortgages and how you can take that money and invest it in real estate and still keep your home. So won't this be fun? Harlan, please take it away for your 15 or 20-minute presentation. And our favorite parts are questions and answers.
Yes, I look forward to that. I don't like just talking straight and not getting any feedback. So I will go through some of the basics as quickly as possible. Now, the first thing that everybody thinks most of the time when they think reverse mortgages, by the way, just kind of a quick show of hands, how many of you are planning on getting a reverse mortgage when you turn 62? Nobody. That's the way it always is, isn't it? Oh, one. All right. Awesome. We have one. I was talking to a group of attorneys and financial advisors, about 300 of them in Fort Lauderdale last week, and one hand went up out of 300. And it's like crazy. Why is that? Why does everybody not like reverse mortgages? It's really cool because you can borrow money and you never have to pay it back until a year after you're dead. So, I mean, how much better does it get than that? I mean, there are no other loans like that. I'm 62 in April, and I turned. And yes, Seema said I thought reverse mortgages were for old people. Yes, in fact, there was a newspaper article a while back, and it said the only people that should get reverse mortgages are people that are old, broke, or stupid. And if you're all three, that's a good idea to get a reverse mortgage. I mean, it's just, that's what people think. Now, I'm old to people that are in their 30s. They think I'm old, but I meet 80 and 90-year-olds and they think I'm a young person. So you can get a reverse mortgage at 62. Or if you have parents or grandparents, you can get reverse mortgages earlier. If you're single and you're in your 40s or 50s, you can marry somebody who's 62 and then you can get a reverse mortgage also. But I'm not saying you should marry somebody else so you can get a reverse mortgage, but that's just, a fact. Ourtime.com, silversingles.com, that's where you find old people online. But anyway, that's not what is my recommendation for today. So I want you to think about the fact that all of us know that you can build wealth through real estate. That's, that's why we're in this business, in the mortgage business and the real estate business, because we know that you can build wealth through real estate. So the problem is that most people don't understand how to use that wealth. And in fact, most people don't know how to use that wealth. Now, the big thing, and I want you to just bombard me with questions, and I want you to be skeptical, because most people that talk to you about it or that you visit with are going to say, no, that's not a good deal. That's not something that you should do. But what you really want to think about is a reverse mortgage is a multi-tool. It is something that can be used for all kinds of things. You can obviously buy real estate with it. You can pay for long-term care. You can pay for healthcare. You can just eliminate your payments. You can put it to work in a variety of ways. And people just get hung up on the fact that, well, reverse mortgages is for people that are broke or people that are old or people that haven't saved well or whatever. It's simply a way to use the equity that went inside your house. So I'm going to ask you a really simple question, just to make sure we got audience participation. I'll take a look in the chat box. What color is a yield sign? We're going to start with real easy questions, and then we're going to go with harder ones. You can type that in real quick. Whoops, where'd it go here? I went and put that down a little bit too quick. Or you can just unmute yourself and say what color it is.
Oh, yeah, yellow.
I think a yield sign's red. I know the stop's red, but I think the yield's red too.
It's yellow.
It's red.
Okay, if you are you sure? Because yield signs are
red and white.
Yellow.
Red and white.
What?
Yeah, they've been red and white since the 70s.
What?
They used to be yellow. They changed to red and white in the 70s. I lost $100 on this bet because I was sure that yield signs were yellow.
Well, I'm going to tell you, I've never seen a red yield sign.
Really?
Well, I guarantee you're going to find them now, because when I lost my $100, I looked all over the place, everywhere, for a red and white yield sign, or a yellow yield sign, because I was ticked that they were red and white. And so what you think about things, you really, I read a book a long time ago called Don't Believe Everything You Think. And there's a lot of people that believe incorrect things. Seema, I thought there were old yellow ones in rural areas too, and I looked all over and I couldn't find them. So if you can find some, maybe I'll get my $100 back. Take a picture, tell me where you saw it. But it's really difficult to find these things. So the issue is that it's dangerous really to make decisions based on thinking that was from decades ago. So what I want you to think about, I'm not going to go through all these slides, but what I want to jump ahead on here is I'm going to show you a cute little diagram and of 3 buckets. Everybody who owns a home has 3 buckets. I don't know why that keeps bouncing off there. Everybody who owns a home has 3 buckets of wealth. Bucket 1 is your ability to make money. Bucket 2 is money that you put aside for the future. 401k, stocks, bonds, IRAs, liquid money that you can get your hands on. Might be taxable, but you can get your money on your cash value life insurance. You can get your money on your 401ks, your savings accounts, whatever. And then there's, of course, home equity, real estate equity. Real estate equity, I'm going to hurt some of your feelings right off the bat. Real estate equity is worthless. It's worth absolutely nothing. Nothing. You can do nothing with real estate equity until you turn it into cash. And the only 2 ways that you turn it into cash is selling it, which sometimes you can make a lot of money in selling it. Sometimes it's taxable if you sell it, or doing a mortgage. But when you do a mortgage and leverage the property, you invariably have a payment, which those of you that are younger than 62, that's what you've got to do. And that's what I've done for a number of years until I got to 62. So think about the pre-retirement wallet, the 18 to 62 years old. And I'm not retired and I'm over 62, but there's the working type wallet. And then there's the bottom one where it's post-retirement. You might still be working, but you're over 62. So if you look at the life cycle of the money, everybody makes a whole bunch of money in bucket 1, and you put it up into your wallet, and most of it evaporates right off the top, and you spend it on food and clothes and cars and kids and whatever. Something called the cost of living. I saw a sign outside a church a long time ago, and it said the cost of living is high, but it's still extremely popular. So even with inflation, so we have to pay to live. However, after you pay to live, you've got some money left over, and you dump it into your nest egg. And you put it into bucket 2 in your savings account, your IRAs, whatever. What you also but what you can also do is you can put money into bucket 3, which is equity, and you can pay off houses, you can buy houses, you can do down payments on houses, you can pay cash for houses, you can have rental properties, you can have second homes, you can have Airbnbs, whatever. But most people want to pay off their house, which is a huge mistake. Most people, I'm not saying everybody on this call, but most people want to pay off their house because they think that then it's safe. At least I'll have a place to live. I might finance my investment properties, but I'm going to pay off my house. Well, actually, that's a mistake, because when you get down into your 62 plus wallet, where I am, and you want, even if you're 30 or 40, you want to pay attention to this, because that's going to affect how you do your planning in your 18 to 62-year-old time period. So when you get to 62, bucket 1 might slow down. You don't make as much money. You're not working as much. You're working less. You don't make as much money in commissions. You're slowing down your real estate business, whatever. And so then most people go to bucket 2 and they start drawing money from their 401ks or IRAs, or they draw Social Security from bucket 1, whatever. But very few people take money out of bucket 3. In fact, there's now $11 trillion in bucket 3. It's the largest asset class in the history of any country in the world. We have done an awesome job of teaching people how to save money through real estate. We've done a horrible job of teaching them how to use it, because we tell them, just put it into bucket 3. And when you die, well, then you can give it to your kids, and then the kids will sell it and convert it back to cash, because they don't want to live in your house most of the time. They obviously want to live in their own house, because you're 90 and they're 60, and they're not really interested in moving into your house when they've already been in their own house. So, and besides, if you have 3 or 4 kids, which kid is going to move in? So the bottom line is that when you think about it, equity is something that should be constantly converted to cash throughout your entire lifespan, not just when you're working, and you keep leveraging that real estate so that you can use that money to buy more real estate, or use that money to enjoy life with, because after all, what good does it do to amass wealth if you can't do anything with it? So let's talk about how a reverse mortgage works. the way that a reverse mortgage works is really pretty simple. You think about putting money into a house or your real estate when you're younger, and then you take it out when you're older. Now, unfortunately, right now, the only house that you can take money out of is a primary residence. So it's only a primary residence that you can pull money out of, but that's the one that people pay off most of the time. So how does that work? So what happens is this, and I will go back to my other slide here, is you will have three options of how you can get money out, and you can get about half the value of the house out of your turn into cash when you turn 62, and you can take it out in a lump sum. That's when you're buying something or purchasing something. You can have it in a line of credit. We had a real estate agent in South Carolina that she just kept this line of credit, and she kept flipping houses, never had to make a payment, but kept flipping houses, putting the money back in, getting another house, putting the money back in, and just continuing this circle. So you can do it in a line of credit. So if I've got a $600,000 house, I can take out a $250,000 to $300,000 line of credit, depending upon my age, and I can use that whenever I want. I can pull the money out, put it back in, pull the money back out, leave it out, never make a payment, and the interest continues to accrue. So I will owe more money in the future, but I don't care because I've got more money in bucket two. I've got more money in other real estate because I'm leveraging that money. One guy took out $300,000 out of his reverse mortgage, and he put $50,000 down on six properties, six other. So you could use it as a down payment. You could use it to pay cash for another property, whatever you want to do with it. Some people use it for income because they don't want to buy anything more once they get older, and they just want to pull income out of the house, but they still want to live there. So that's three different ways to get money out, either in a lump sum, line of credit, or monthly loan proceeds. Now, the issue is people say, well, yeah, but then the balance gets to be a lot bigger. And that is true. The balance goes up, not down. And so what you're going to see is that the balance continues to increase if you're not making payments, because you don't have to make payments. But that's where people get really confused, because they say, well, just a minute, if I do that, then I'll owe more than what the house is worth. Well, guess what? The cool thing is you never owe more than the value of the house. It's guaranteed by the Federal Housing Administration, and no matter what happens, you are guaranteed that you will never owe more than the value of the house. So I'm going to show this to you in a picture on a graph, which is the easiest way that it makes the most sense. Is that reverse mortgage is very different than a forward mortgage. You know what a forward mortgage looks like. A forward mortgage looks like different than this, in that a forward mortgage always, as the house goes up in value, the orange line, the amount that you owe, goes down to zero because you keep making payments and it goes down to zero. With a reverse mortgage, the orange line continues to go up. You owe more every month, every year, because you're not making any mortgage payments. It's being paid for out of the equity, not out of your cash. So you can use your cash for other things. So if the house goes up by only 2% and the reverse mortgage amount goes up by 6%, which is unusual because usually you're going to have the house go up by more than 2%. The average for the last 100 years has been 4%. And obviously there's been much higher appreciation in other areas. But as this continues to go up, there is a possibility that the amount that you owe in your late 80s or 90s could be more than the value of your house. So now the program didn't work, right? No, it worked very well, because if you get over here to the right side of the graph, and you are in a situation where you owe 1.5 million and the house is only worth $1 million, and you die, well, guess what? You never have to pay it back. It's forgiven with no tax consequences, and all of the other money that you keep is yours, or well, you're dead, so it's not yours, but it's your heirs. And so you can pass that on. And even if you sell the house while you're alive, you never have to pay that difference. But usually there's going to be equity left in the house. So if my house is worth 800,000 and I owe 600,000 and I die, the kids get the other 200,000. So if there's equity left, it goes to the kids. If it's good, the kids get it, or whoever your heirs are. If it's bad, over on this side of the equation, FHA gets the bill. And you got to use all that money. For example, my uncle died at 94. And when he died, he was upside down in his house. But he had used that money to buy the rental property next door that he rent out and got a stream of income from, and paid cash for the rental property because he wanted to control who the renters were that was next door. And he was able to get the cash flow off that property. He still had $300,000 left in bucket 2 in all of his other investments. And then he had the house left over. It was worth $250,000 or whatever. So all of that money went to him. But when he was upside down on his house, because he had never changed out the red carpet and the green sinks and the green tubs. And I told the real estate agent, I said, hey, all of that stuff is coming back. I think it's called modern art deco or something. And you're going to be able to sell this house for a lot because it's got green tubs and green sinks and red shag carpet. And he said, oh, no, it's not coming back. So anyhow, his house did not sell as well. And so he was upside down. And the difference was forgiven, but all of the other money that he had amassed in his real estate and the money that he had left in his investments went to his kids because he had properly leveraged and used the wealth inside of his home. There's 11 trillion sitting in people's homes, your parents, your grandparents, your friends, your relatives, maybe you. Obviously, a lot of you are younger, but as you're looking at the house overall, do not plan on paying off your house. Because if you do, you can't properly utilize the reverse mortgage at the end and keep everything leveraged and own more in bucket 2 than what you would in the other side of the equation. So I threw a lot of things at you real quick. Questions, comments that some of you have, because that may have raised some questions. One of you, Kathy, was already going to do a reverse mortgage. So Kathy must already know how this stuff works. But questions, and don't be afraid to disagree with me, because most people do. Most people say, nah, I don't think that's a good idea. I think it's a good idea to pay off, at least pay off your primary residence. You might want to finance some other stuff. But, and realize that back in the old days, I did not believe in reverse mortgages. I said, no. Reverse mortgages are bad. They rip off the old people and screw their kids. You should never do them. Well, I found out that I was wrong. And that's why I made sure that I planned to do my own reverse mortgage. Okay, go ahead, Peggy.
Okay. So thank you very much. That was very, very interesting and very enlightening. And I like to talk about the bottom lines, the money. How much does it cost? And you also talked about the real estate agent who had a line of credit and kept paying the line of credit back. So that is never heard of that before. So I'd be interested to understand more about that. But sure. I understand it's quite expensive to do these reverse mortgages.
Yeah, let me address the cost factor this way. This is a rotary dial telephone for some of you that are younger, this is how some of you would not know how to dial a rotary dial telephone. But this is a rotary dial telephone. It costs $20 on eBay. How many of you are still using rotary dial telephones? Because they're cheap. They're really, they still work. They don't break very easily. You can plug them in and they still work. How many of you use a rotary dial telephone? How come? They're cheap? They're a good deal.
They don't work the way your phone is anymore.
Exactly right. So we pay $1,000 for these things that are plastic, and we have to replace them every 2 years. My mom and dad had the same rotary dial telephone for like 20 years, I think. The issue is that, yes, reverse mortgages are more expensive, just like cell phones are more expensive, but it's what they do. And in a sense, think about it this way. I was in Charlotte, North Carolina yesterday, and this morning I flew back, and I was just kind of goofing around at the airport when I plugged in my map. And it said that it would take me 7 days, I think, to walk home. It would take me 20 hours to drive home. And to get on the airplane, it was 2 hours. But that was the most expensive. I had to pay $240 for the flight back to Minneapolis this morning. So the issue is that, what do I get for my closing costs? The closing costs are exactly the same as a regular mortgage, because every state has different mortgage coupon stamps and everything else. But nationally, a reverse mortgage costs exactly the same as a forward mortgage, except for one thing. 2% of the value of the house has to go into a mortgage insurance fund that FHA administers. 2%. That's a lot of money on $1 million house.
Of what? 2% of
2% of the home value. So if my
Which
home
was
is worth $1 million and I only set up a line of credit, I got to pay $20,000 on $1 million house, even if I just set up a $400,000 line of credit. So people say, whoa, that's crazy. I got to give up $20,000. I've got to pay $20,000. You don't actually pay $20,000. We take that out of the equity and it's due a year after you're dead. So you don't really pay it. You're paying for it technically with equity, and you're going to pay for it when you die, but it isn't something that you pay now. You pay for it with equity, which is kind of like beads. It's not real money. You don't have to pull money out of your investments or pull money out of your Social Security to pay for that. So
But
the
that's an insurance policy. So you're purchasing an insurance policy for the lender. So that
no, that is an excellent point. It is not just for the lender, it's for you and your kids. So what do you get for that $20,000? I paid $30,000 for closing costs on my $1 million home when I did my reverse mortgage. So what do I get from my 30 grand? Well, I get the normal closing costs I would have paid anyway, but the 20 grand guarantees me three things. It guarantees me that I never have to make a payment for as long as I live unless I want to for tax purposes. And I will for tax purposes. We'll get to that in a minute as to why sometimes it makes sense to pay it and then pull the money back out. Number two, it guarantees my kids. Fred already asked the questions. Are there any situations where the heirs will end up with a liability to repay the lender of the reverse mortgage? Never. It guarantees my kids. That insurance policy guarantees that I never have to make a payment and guarantees that my kids never have to make a payment. We're putting the entire responsibility on the value of the house. Now, if the value of the house doesn't go up and the house doesn't have the money, FHA has the money. That's an incredible guarantee and a great insurance policy that guarantees my home equity, even if the value of the house goes down. Do you know how cool that was in 2009 when real estate values crashed? Nobody was upside down. And yes, Angel, the heirs keep the house. So when my cousins inherited the house from my uncle Arvid, who had that, the house with the red shade carpet, they still inherited the house. They could sell it on a short sale, or they could pay off the loan to up to 95% of the value of the house, and they'd get the house back, plus the 300 grand that they got that he had never paid off on the house in the first place. So they were in a way better position. If you leave your house to your kids with a reverse mortgage and leave them instead the other money instead of paying off the house, your kids will be better off. That is really an important part. Doug, you had a question on your hands.
Yes, he does. Doug?
Yeah, I do, but the more you're talking, the more things are popping into my head. So I'll stick with my first, because I guess ultimately for me, I'm still not quite sure what's the difference between me doing a cash out refi that I would do right now and doing a reverse mortgage. Why is the reverse mortgage something better to do if I have equity in the home than a cash out refi?
Well, obviously, Doug, I'm judging that you're not old enough to do a reverse, so you have to do a cash out refi. So that's the smartest thing to do when you're younger. And I did cash out refis all the time to use the equity in my house to acquire other real estate. I own a number of other pieces of real estate. And even though I also have some life insurance and IRAs and stuff, the majority of my net worth is in my real estate, just like you guys. And so the issue is I always use that to leverage to get to the next level. But when I'm 62, things change because I may not want to work as hard. I may not want to keep flipping houses or investing in commercial property or whatever I'm doing. And then I don't want to pay the payments back. If you do a cash out refi, it increases the amount of money that you owe and it increases your payment. So you take out 100 grand, now you got to pay back 150. That might be easy to do when you're 30 or 40. When you're 60 or 70, you don't want to pay back 150. You want to get some of that income out because you built the wealth. You want to use some of it. You don't want to just be in a situation where you can't put your hands on that money. Because if you own $1 million house and it's paid off, all that money is sitting in your house in a glass case. And you can look at it, you can talk about it, you can brag about it, you can show it to people, but you can't do anything with it. All we're doing is saying you can use it and you don't have to pay it back until after you're dead because you've already created enough equity in your house. Now, you don't get all the equity, so we're not going to give you 100% of your house because we got to leave room in there because of the FHA insurance funds limits how much money we can give you. So if you're 62, you only get about 40%. If you're 72, you get about 50%. If you're 92, you get 75%. So the older you are, of course, the more money you get. But if I've got $1 million house, I can pull out $400,000 and still have no payment. Even though I have no payment with $1 million paid off house, I have no payment with $1 million house with a $400,000 mortgage that continues to grow and have more and more money available. So going back to Peggy's question about the real estate agent, she had roughly $1 million house and she had a $400,000 line of credit, and she used that line of credit to buy a house. So she ran up the balance, interest was charged, then she flipped the house, made money, paid it off. So it was paid down to $1,000 or $10,000 or whatever. And then she went and did the same thing. Instantly available money, never had to make a payment, never had to worry about cash flow because she didn't want to. She was 62 and she didn't want to worry about making a payment. So she never made a payment. And every time she paid off that interest, she ended up that accrued during the flip. She got a tax deduction on all of it, even though she never wrote a check ever for the payment. She just got a tax deduction on the interest because when you pay us back, we still give you a 1098 for the interest. So she was able to very effectively do that without ever worrying about her cash flow. Now, in my situation, I'm not using it to flip. I used it to pull all the money out to pay off an existing mortgage. I'm going to save a couple $100,000 in taxes by simply paying the mortgage that mortgage interest every 3 or 4 years, which will be $50,000, $60,000, $70,000, $80,000. And then I get a 1098. And then after I pay the money in, I can pull it back out again and continue to use it without ever making a payment. So I built my wealth through real estate and now I can use it. And like one of our loan officers says, I can have my cake and leave it too. So I can still leave it to my kids if they want it, but I can live in it with zero risk for the rest of my life without ever making payments. And if I die, my wife can live in the house with zero risk without making a payment. She's got to pay the taxes and insurance just like she would if the house was paid off, but never a worry about making a payment. And that money can be used for other things.
But
which
you
is
said
why
within a year, after a year, it was due. So
it's due after a year after both of us are dead. That is correct.
is she signed on the loan also?
She is. In fact, that's
Oh,
one
okay.
that's one of the things that caused the problem with reverse mortgages is older guys. I have an underage wife. She's only 59. And if you're under 62, you got to be married to somebody, like I was joking about before, you got to be married to somebody over 62 to be protected by the mortgage. So Brenda's 3 years behind. But when I did my mortgage, I had to include my wife as part of the deal. I could not take her off from title and do it separately because a whole bunch of people did that and then they died and the wives got kicked out of the house. And man, that was some horrible, horrible press. ABC News with Diane Sawyer and front page of the Wall Street Journal and front page of USA Today, and all these poor widows are without a house. That's because of their stupid husbands taking them off from title. It wasn't the fault of the reverse mortgage. So we had to come out with a law in the industry and saying, you can't take your wife off from title. You have to leave her on, or your husband if he's younger, whatever the situation is. So that is a horrible thing that happened in the industry that shouldn't have, and it gave us a really bad name and a bad reputation that we were kicking out widows out of the houses when it was really the fault of the husbands who did not include their wife on the business deal.
So
and that's an important question.
Help me understand that because you're saying the heirs would be able to actually take care of getting the house back. So why would mom get kicked out even if dad did take her off of title?
Because it was due. The loan was due and had to be refinanced into a forward mortgage or paid off when dad died. Well, most widows didn't have the ability to refinance the mortgage into their own name because they didn't have any income or anything at that stage of the game. And so they had to try to pay off the house. And if they couldn't, they had to sell it because the loan's due within a year. Like Peggy just asked, when's the loan due? It's due a year after you're dead. And so mom had to pay it off, just like the kids would pay it off. Well, the kids don't mind paying it off because if they sell the house for $500,000 and then they pay off the $300,000, the kids still get $200,000. So the kids are happy to do that, but that doesn't work when you still want to live there.
Gotcha.
So the kids have complete control over the house at the end. You inherit it, and we come to you and say, Doug, what do you want to do with mom and dad's property? They owe $300,000. It's worth $500,000. Do you want to refinance it into your name, Or do you want to sell it? And if you want to sell it, you got a year, let us know when you sell it, and we'll tell you what the payoff is.
Of which it's also accumulating more debt in that year because it's not making any more payments, but it's still accumulating interest that's owed. Correct?
It is. That is correct. But no, you can make payments if you want. If you have if mom and dad have a forward mortgage, you have to make payments.
Right.
So
Right.
So let's remember, when you have a reverse mortgage, you will die with less equity, but you'll have more cash. You'll have more cash to enjoy while you're alive, and you'll have more to pass on. So everybody thinks, well, this decreases inheritance and this screws the kids somehow. Well, no, it just gives the kids less equity, but they get more cash. I helped all 4 of our kids buy a house. And that means that I have less money now because I helped them buy a house, but would they rather have an inheritance now or later? And so I want to help my kids build wealth through real estate when they're in their 20s, rather than give them a house when I'm 90 and they're 60. So if you talk about family wealth, the best thing you can do is, in fact, right now, parents are taking money out of their house, giving it to their kids because some kids can't afford 7% interest rates. And so they can, we just had a lady in Washington that pulled 200 grand out of her reverse mortgage, which she doesn't have to pay back, gave it to her daughter who just recently got a divorce, single mom, and gave her 200 grand so she could afford to move into the same neighborhood as mom was, so mom can help raise the little granddaughter, the little 5-year-old granddaughter. So, and some people use it to buy rental properties, and some people use it for an Airbnb or a second home, whatever the situation is. Yes, sir, David, do you have a question?
Yeah, hi, can you hear me okay?
Yes,
I sure can.
you can, David.
Hi, Peggy, hi, everybody. Let me put my mic shot on here. Yeah, I had a question in reference to the reverse mortgage. I had some people talk about reverse mortgage and maybe some investors trying to invest in that way, or at least helping out in the situation. So what are the laws for a third party to come in to help out with taking it over, or some sort of other solutions?
So are you saying if you would fund a reverse mortgage for an older person, like if I needed some money, if you came in and loaned me some money, is that what you're talking about?
Yeah, just different strategies. I mean, if that's one, or if there's others, but yeah, I just trying to understand more of the rules of reverse mortgage.
Yeah, so there's 2 different kinds of things. There's reverse mortgages, not to be confused with the shared equity loans that are not really loans. We don't do those at Fairway at our company. We only do federally insured reverse mortgages and some proprietary loans on jumbos. But there is a huge market out there for people that are near death. They're in a situation, where they're trying to sell, but they really don't want to move yet, and they maybe got 2 years left or 3 years left. That's not a good use of our product, because the closing costs are high and our program is designed for 3 years or more. So if it's under 3 years, there are places like Open Door and some other companies out there where you get a sale leaseback. And you give your client $80,000, 80% on 100% value, because we're limited to 40 to 60%. So they need more money. They need a bunch of money now, kind of like selling your life insurance policy. You see these ads on TV for Coventry and stuff like that, where you sell your life insurance policy. That's a similar situation, in that you'd come in and give them a much higher loan to value than we could, because they aren't going to be there for more than a couple of years. Our clients might be in the house for 20, 30 years. They might only be in there for 5 or 10 too, but they could, this loan is not due until you're 150 years old. So it's not a 30-year loan. But you guys can come in as investors and say, hey, we'll give you 80%, but you got to move within 3 years, and you're going to have to pay $800 a month rent for the next 3 years while you're staying here. That is an entirely different industry, and it's not very well regulated. So there's definitely a potential for a lot of abuse there. And because we're a mortgage company, we're not involved in that, because those people are taking either 100% stake or a partial stake in the future value of the house. But it can be a good situation because you're guaranteed to get a return. You've bought that house at X level. You've only paid 80% for it. But you're letting them live there at a reduced rent for 3 years or whatever. And then you're guaranteed to get that house, and it'll probably appreciate over the next 3 years. So it's a pretty good deal for you as a real estate investor. So that is, it's just bad because it's not real well regulated, and some people that are older might have onset of dementia, and you can take advantage of some people. And so you want to go in there with a lot of ethics.
I told you I couldn't answer that question, David. So,
Yeah. Yeah,
so
I just wanted to-
Harlan did. Well, that was great. Actually, that's really good. Now I understand it. We could have a conversation. But Harlan, Fred's got a couple questions here. And
Oh, yes, Fred, what's the interest rate that's used to calculate the interest cost in the line of credit? Is it
and he
fixed
also
or
want to
variable?
know about the liability, if there would be any liability to repay the lender of the reverse mortgage by anyone. He was talking about the heirs.
Right. There is never a liability, ever. The house, this is the only mortgage in the world other than some commercial loans that are, that the house is 100% responsible. It's not a person that's responsible for the loan. So when I signed on my reverse mortgage in April, I signed a paper that said release of personal liability. I'm not liable. My kids aren't liable. My estate's not liable. My trust isn't liable. The house is liable for the loan. I'm pledging the equity in the house to make the payments. That is very different than any other loan that you take out, because every other loan legally that you take out, you're responsible for it. If you take out a car loan and you smash up the car without insurance, you're still responsible for the loan. In a reverse mortgage, you are not responsible, nor are your heirs. It's impossible for you to be responsible for the loan because you are pledging the equity. And if there's not enough equity, as the lender, we have to go to FHA. We cannot legally ever ask you for money. And so it is the safest loan possible that you can have in the fourth quarter of your life. There's not, people say reverse mortgages are risky. Oh my goodness, they're anything but risky. They're guaranteed that you can never make a payment. You can never get kicked out of the house, and you can never owe more than the house is worth. So the only risk that you have is how much equity you're going to use, which you're alluding to, Fred, in your question on the interest rate. So the interest rate can be fixed or variable. Mine is variable on purpose because a variable rate allows me to get a bigger tax deduction and allows my credit line to grow faster, which is exactly the opposite of what you want in a forward mortgage. It's the reverse of what you want in a forward mortgage. Because I don't care if the interest rate, my cap on my interest rate is 13%. I don't care if it goes to 13%. Right now it's about 6.5%. But I don't care what it goes to because my payment is always zero. And if I pay it down, I'll just get a bigger increase in my line of credit and probably exceed the value of my house. If the interest rate is low, I'll keep all the money out all the time and put it into other investments. So you can get a fixed rate right now for about 6.5% or 7%, or you can get an adjustable rate for about 6.5%. Not a big difference, but the interest rate that is variable allows you to put and take back and forth. It would be dangerous to do a forward mortgage variable when you're older. It's just dumb because you could get in trouble because the payment could double. With a reverse mortgage, your payment is always zero, guaranteed to be zero. It can never change. And it's tied to, excuse me, real quick, it's tied, Fred, to the CMT, the Consummatory Treasury Index, plus 2.5%. So that's where you get the interest rate. So it's similar to a 30-year fixed rate.
And is it the same in every state?
It's the same in every state.
Regulated?
Yep, this is the federal.
Federal, it's not state, correct?
That is correct. There are some states that don't allow some of our proprietary loans, but all states allow the federal FHA loan.
Okay, thank you. Doug?
Okay, so I'm just trying to get the numbers straight in my head. So we'll just use some really simple numbers. So maybe one thing, is this only available if my home is already paid off? That's the time that you can do a reverse mortgage, or if I still owe a little bit on the home, it's not quite paid off, can I still do a reverse mortgage?
My goodness, that is an excellent question. I should have answered that earlier. I had realized that all of you that are young should not try to pay off your house. You should only try to pay it down to about 50%, because if you pay it down to zero, then of course you have no payment. But if you pay it down roughly half or a little bit more, you also have a zero payment. So this is my personal amortization schedule from April that projects out what it will look like until I'm age 100. Where'd it go? I just had it here. And so this shows that I started, I still had a $400 and some thousand mortgage when I went to do the reverse. It was still there. Here we go. Got too many things open here. Okay, so you can see the loan balance in the middle here, 479,575. Everybody see that?
Yes.
So I have my house is worth 1.2, and I paid off a lien of 442,000, and I pulled out 32 grand cash because I wanted it all to do some improvements on some of my properties. And so I took all of the money out in a lump sum day one. So I don't get any check. So I've got a growing line of credit that keeps going up, and I would have to pay into this to get money back because I want to keep all of my money working all the time. So I don't have an available line of credit because I don't want an available line of credit. I want all of my money out right away. So as this continues to go up, you can see when I'm 70, I'll owe 709,000. When I'm 80, it'll be $1 million. Do I care? Theoretically, if my house goes up by 4%, when I'm 80, my house will be worth 2.6 million. I only owe $1 million. Do I care? No. Well, my house might not be worth $1 million, but it should be, or 2 million. It should be, because in 20 years, inflation should certainly drive the value of the house up. But if it doesn't, I'm okay. I'm protected. And so if you just take a look at this million, if interest rates go up, I'll owe $1.5 million or whatever. Again, I don't care, because that other money is doing things. I bought an investment property in Florida the day after, or the month after I closed on this one, because I just freed up my credit line, or I just freed up my my debt to income ratio, and I could buy another property right away, because the payment on a reverse mortgage is always zero. Doesn't even show up in your credit report because you don't owe it. The house owes it, which is weird, but that's the way that it works. Now, when I want to make payments and I sell a property and make a bunch of money or whatever, I pay it down on my reverse mortgage. So let's say that I sell a property when I'm 70 and I made a bunch of money, 300 grand. I'm just going to pay the 300 grand into here, knock it right back to 400,000. And I got a $300,000 tax deduction because I paid interest for 10 years that had accrued that I never had to pay, but I wanted to pay. So that's what, and guess what I can do then? I paid it down by $300,000. I can pull that 300 grand right back out and do whatever else I want with it.
That's not principal, it's all interest.
It's all interest. So when I pay it down, if I paid it down right here at age 70, 709,000, I wrote a check for 300 grand. Immediately that 300,000 goes over here into the line of credit, and my balance goes down to 400 grand.
And now you can draw on a line of credit.
All of it tax-free whenever I want.
Right, because it's borrowed.
Yes, because it's borrowed money.
So answer your question, Doug?
I think so. So I think what you're saying is that if I was in your situation where I got $1 million home, I'm 51 right now. So in 11 years, if I was able to get the value of my home down to $400,000, or actually whatever the value of my home was, since the value of my home is at $1 million, then if I do a reverse mortgage, I would receive $400,000. 40% of the value of my home. And at that point, I no longer have to make mortgage payments.
That's it. That's exactly correct. I mean, isn't that weird? Nobody's ever told you that all you got to do is get your home down to 40% and then you're done making mortgage payments. I mean, my wife was, I was snoring several years ago, and my wife elbowed me really hard, and I woke up in the middle of the night and I said, over 62, 50% equity, still making a mortgage payment. And she said, you are sick. All you think about is reverse mortgages. And I said, that's just top of mind. If you're over 62 and you got more than 50% equity, stop making mortgage payments. You don't have to anymore. And so there's two ways to get out of doing mortgage payments. Pay your mortgage off. The second one is just pay it down. to 40%. And it used to be 50%. If the interest rates go back down, then you'll be at 50% because the interest rates control your loan to value. So if the interest rates go down 4 or 5%, then we're at 50%. You can see mine was calculated off of 970, and I got 479,000 out of 970,000. So I got over 50% because I locked it in. I didn't lock my interest rate in, but my expected rate when the calculation was made was at 3.43. It's now at 6.5, which is good because now I'm going to have a bigger tax write-off. But there's two types of people that this can help. The people that didn't get the memo that you don't have to make a mortgage payment, you don't have to pay it down to zero. And then there's the other people that that paid off their house or that didn't pay off their house, like me, either by design or by choice, and we will pay off their mortgage and give them a zero payment and a tax write-off. But if you never heard that and you paid it to zero, well, then we'll just give you a check for 400 grand or a line of credit for 400 grand, whichever you prefer. So it's just really properly using your wealth. None of us would take $1 million and put it into a CD and just say, okay, we're just going to leave it in a CD for the rest of our life. We think that's a pretty good deal. And if we can make 3% interest on it, that'd be great.
No chance.
But that's what everybody does when they pay off their house.
Yeah.
Because they're not getting a return on it. They're not making any money on it. They're not keeping that money in circulation, doing something. Cliff, you've got a question.
Got a question.
Yeah, so I just want a little clarity. So with the reverse mortgage, they're actually receiving money, and is that increasing the interest that's owed on the house, or the principal that's owed on the house, or both?
You missed all of that.
Well, I dialed in earlier. I wasn't able to be
Cliff
on.
was late, so.
Well, I actually called in, but I couldn't really.
So no, this is a tough concept. So Chris, if I owe 400 grand, it's going to increase the interest that's owed. Okay. So my balance is going to go up every year by, if it's 400,000 and the interest rate is 6%, it's going to go up by 24 grand a year. So in 10 years, I'll owe $100,000 more. So if I started at 400, I'm going to owe 500 if the interest rates stay at 6%. Okay. So now my new balance is 600,000 that I don't have to pay. But if I do, then I will be able to get a refund of all of that money because my line of credit went from 400 all the way up to the 500 to be able to make that increase from there.
And then when the owners of the property are deceased and it passes on to their children, the interest is due to them a year after their death?
It's not due to them. It's due when the house is sold. So think about it this way.
So they sell the house. Okay.
They sell the house. So if I have a forward mortgage and I owe $400,000 on my house and it's worth 600 and I die and the kids get it, who owes the bill? The house owes the bill, not the kids.
Right.
Because the kids
so
inherit
as long as they
house.
don't sell it, then there's nothing owed on that. Is that, am I correct on that?
Well, no, they still have to come up with the money in a year because they didn't get the mortgage.
Okay, so even if they don't sell it, they still have to pay it.
Right, but that applies to a forward mortgage or a reverse mortgage. Doesn't make any difference. If there's 400 grand owed on the house and I inherit the house and I sell the house, I get the 200 that's left, but I got to give the lender 400 because that's the balance on the mortgage, whether it's a forward mortgage or a reverse mortgage. So everybody freaks out and says, well, when Uncle Arvid died, the bank got most of the money. Well, no, Arvid got most of the money and he bought the house next door, which went up faster than his house. And so the kids got the other house. They didn't get as much equity out of Uncle Arvid's house because he used it. The bank didn't do it. The bank charged the interest, but Uncle Arvid was able to take that money and either enjoy it or buy something else with it that was of more value.
So if the kids wanted to actually convert that house then into a rental property, then 1 year after their death, then they would actually have to pay that interest back?
Well, they would they'd refinance it. We'd simply go to the kids and say, what do you want to do with the house? Well, we want to keep it. We want to turn it into a rental property. Okay, well, we'll give you an investor loan then. And we'll refinance the 400,000 into an investor loan. Okay. And then you would pay that $400,000 back in the form of a loan. We would never encourage them to pay for it with cash. You know, you would be better off leveraging it just simply from the perspective of the investor scenario. Now you say, well, what if the kids can't qualify? Well, if the kids can't qualify, they probably shouldn't own an investment property. But if you want to make sure that you help your kids out, well, then give them a life insurance policy to pay it off, because it's cheaper to buy a life insurance policy than it is to pay off the house.
That's a very interesting idea. I like how you couple that. That makes sense. It really does.
What's
I have
that,
11. I have
20,000?
11. Well, I'm sorry.
What's that $20,000 insurance policy we paid for?
The $20,000 insurance policy guarantees that I never have to make a payment and I'll never be upside down in the house, but it does not wipe out the ability for me to pay off the
So
difference.
yes, not a combination.
It's-
You might
not
just
a
get an
life policy.
outside policy that gives them enough coverage that would cover the amount of interest that they would have to pay. So if they chose to keep it, then it's all covered.
Exactly
So
correct.
with that, what you're talking about sounds like a no-brainer.
It really is. When you start looking into the numbers, I've talked to people that were completely against reverse mortgage, and we looked at the numbers and said, you tell me what makes the most sense. You cannot. Can you give your kids the house free and clear? Yes. Do you want to give your house free and clear? That's one of the most inefficient ways to pass on wealth. The most efficient way to pass on wealth is to have a reverse mortgage, use that money, and buy life insurance. I have a second to die policy, so my kids will get more money when I die than if I would pay my house off, and they get it tax free. So I don't sell life insurance, but I buy it because it just makes sense and it's cheaper if you want to leave a legacy. And if you don't want to leave a legacy, don't buy life insurance.
As long as they're healthy enough where they can qualify for a policy, they could use part of what they're getting back in the reverse mortgage to pay the premium.
That's exactly correct. And many
Done.
people do.
Wow. Okay.
Kathy, you're nodding your head on a lot of stuff. You were the only one that raised your hand. We're going to ask again if more people are going to do it. But what do you think about all this? How did you know about these things?
Because I heard you talk about it before and you opened my eyes and I love the idea.
Okay.
So that's why I introduced you to Peggy, because I wanted you to come and share with everybody.
That's
Open
right.
their
What
eyes
am I
too.
thinking? Yes, I knew you're. I knew you were familiar. I'm thinking, oh man, what's going on? That's right. Thank you.
Yeah. So Kathy's a plant. She's a plant.
Yes. Yes, we got a plan. My goodness. Well, if I could convince one, then I thought we'd convince 20. David, I've heard of reverse mortgage properties in foreclosure. What can an investor do to help? The question is, why do these properties go into foreclosure? Because it's like, well, just a minute, you said there was no risk. There isn't, but there's a requirement for every loan. What is the requirement for a reverse mortgage, to keep a reverse mortgage in place, to keep it out of foreclosure? Well, there's only two things. You have to live in the house. So you got to be alive to live in the house. Number two, you have to pay the taxes and the insurance. If you do not pay the real estate taxes, you will get kicked out of the house, because we are required to foreclose when people don't pay their income, or not their income taxes. They can mess around with the IRS, but they can't mess around with the real estate because that endangers our lien. So that is the scenario that causes foreclosures. When you see those kind of foreclosures, sometimes it might be a situation that was already asked about by David, of maybe you can go in and talk to that person about paying their taxes and getting another lien on the property, and maybe getting the deed in the end to help them out to stay in the house. That's rare, however. It used to be common, but in 2015, the rules changed and people had to prove that they had enough money to pay the taxes and insurance based on their income. And if they didn't, we would not give them the loan. And so there's very few foreclosures. The other foreclosures happen after mom and dad die. They no longer live in the house. And the kids do not respond to us, the heirs. And if the kids don't respond to us within 6 months, we put them into foreclosure, because, hey, the loan's got to be paid. Mom and dad don't live there anymore. So that will sometimes cause foreclosures. And then you can bail out the kids by coming and saying, hey, we want to buy the house. And then you can give the kids the money and the kids are done with the foreclosure. Now, does this hurt the kids? No, the foreclosure is against the house. It's not against the kids. So it doesn't hurt anybody's credit or anything else. But all the kids have to do is communicate and put the house up for sale. but some kids are not very responsible. And so we have to resort to legal means to kick the kids out of the house if they're not taking care of the responsibility as the heirs.
So let me ask you another question. Speaking of kids, when you do a reverse mortgage, when you sit down with a couple, do you invite the children that are supposed to end up being the heirs to be in that conversation so they understand it?
Oh, we absolutely do. We desperately want the kids to be involved in the process, because who's going to be involved in the end? Obviously, the kids after mom and dad are dead. So we want the kids to totally understand what's going on. And we also want to help them to understand the 3 buckets. Listen, kids, you're going to get less equity when mom and dad die, but you're going to get more money while they're alive, because they're going to take you on more vacations. They're going to do more things with you because they can afford it now, because they're not making a house payment, and they're not going to spend as much money out of their IRA. So you're probably going to end up with more money. But there is a possibility, if mom and dad live to be 80 or 90, that they're going to burn up all the equity in their house, and they're going to spend their whole IRA, and you're going to get nothing. Are you okay with that? Because they are not buying life insurance, and they want to live it up, and they want to have a great time. By the way, is that okay? Is that okay if a parent does that?
Heck yeah.
Yeah, it's their choice.
Because the parent's money.
That's right.
Okay. So if they don't want to give the kids anything and they want to have a grand old time and leave the kids a couple of gift cards for Panera Bread at the end, that's okay.
Right.
And maybe the kids can buy their life insurance and pay for it.
Exactly. Thank you, Nika. Yes. If the kids want the money, buy the life insurance of the parents and they get the check.
They'll qualify for the insurance.
Yes. Now, what is the best way to leave the most money to your children? Because people say, well, yeah, but I want to leave this to my kids. I want to leave the most money to my kids that I can. Well, a number of people have told me that. I want to leave the most money to my kids that I can. And I said, awesome, I've got a solution for you. And they said, what is that? And I said, die right now. The quicker you die, the less money you use. I mean, dying early gives your kids a bigger inheritance. And if your kids want you to die early so they can get a bigger inheritance, you should disinherit them. Because they don't love you. They don't want you to live. They want your money. I mean, sometimes it's good to find that out. People are weird because they say, well, I want to leave my house to my kids and I want to leave my IRA to my kids. Well, you can't keep all of that stuff and still live. So you either got to spend money out of your house, or you got to spend money out of your IRA, or you got to go back to work, or you got to draw Social Security early, whatever, in order to not do a reverse mortgage on your house. And we've proven with numbers that when you do a reverse mortgage on the house, then everything else is going to be better off. So the people that do a reverse mortgage actually leave more money to their kids. And we do a reverse mortgage vacation every 2 years. All 4 sons, all 4 daughter-in-laws, and our 5 grandkids go on vacation every 2 years. And we call it our reverse mortgage vacation. Because if we were paying a mortgage, we couldn't take them on vacation.
I love it. Hey, Fred, go ahead.
Yeah, I was just wondering if a couple decides to do a reverse mortgage, once they've done it, do they still have the option to sell their property at any time, their home, and then pay off the reverse mortgage at that time, or are they locked in somehow to the reverse mortgage for the full term?
Thanks for that question. I was working with Fred and Helen, and Fred said, I don't want my boots nailed to this floor. And I said, Fred, we ain't nailing your boots to this floor. You can leave whenever you want. I said, when you and Helen got married, did you guys both say till death do us part? And he said, yes, we did. And Helen said, I don't know if I should have, but yeah, I said it too. So anyhow, I said, okay, here's the deal, Fred and Helen. When you said that, you both agreed that you were going to live together till death do you part. When we do a reverse mortgage for you, we say, when we come to the closing altar, we say till death do us part. You say till whenever I want to get out of this deal. You can get out of it's a one-sided agreement. You can get out of the deal in a year, 2 years, 5 years. You can go buy a different house, whatever you want to do. But we can never make you leave. We can never tell you you got to get out, even if the house goes upside down, even if you live to be 150. So it is a one-sided deal. So you are not, one guy was, an attorney was telling me when I was doing a presentation last week, he said, I don't like the inflexibility of a reverse mortgage. I said, what's inflexible about it? He said, well, you can't move after you get one. I said, who told you that? You can move whenever you want. You can move in a year, you can move in 2 years, you can move whenever you want. But and you also have the flexibility of using the money inside your house. What's inflexible is having a paid off house, because you can't control any of the money inside the house. So great questions. So many people think, oh, people say, well, this is not my forever house. And I say, well, of course it's not.
Why
Nobody's
not?
got a forever house. They all die. So there's no such thing as a forever house, but I understand that you want to look at the long-term house. Arthur, you have a question.
Yes, along those same lines. So if you get a reverse mortgage, it's not your forever home, but you don't want to sell it. Can you switch the reverse mortgage to a different property, or do you have to close out and then open a new one on a new property? Can you pull money out and use it to purchase real estate and then move into that property?
Arthur, I should have brought this up a lot earlier. About 9 years ago, they changed the rules and you could do a reverse for purchase. So what happens is, no, you can't transfer it. It doesn't work that way that you can transfer it. But what the deal is that let's say that I've got, let's say we live in Minnesota, okay? And so it's cold here all the time. And well, in summer, a month in the summer is nice. But let's say that at 70, we decide that we're going to move to our house in Florida and we're not going to keep the house up here anymore and the kids moved away or whatever. Well, we owe $700,000 and the house is worth 1.8 million. So we sell the house and we walk away, my wife and I, with 1.1 million. And we move down to Florida. And all the houses now down there cost, $1 million. Well, now I'm 70 years old. So now I get 50%. So I take 50%, 500,000 of my $1 million here. I pay it on the $1 million house down there. I don't pay cash for the house. I pay half down, 500,000. Fairway comes in with the other $500,000, and I keep the rest of the equity to live off from and enjoy life in Florida. So I can put about 50% down at 70 years old when I'm buying a house in retirement. And Fairway comes in with the other 50%, and I'm done making mortgage payments, and I just bought a house for half price.
It's great. So we are past the top of the hour, and I see Doug still has a question. So Doug, ask your question, and then we will close up.
Okay, thank you so much, Peggy. So here's the part that still got me a little twisted. Let's just say I purchased my home with Bank of America. I'm making my mortgage payments. Bank of America is, first position lien holder. They are expecting for me to continue paying so that they can make the money on their amortization charge. Well, yep. I get to 50% or 48% of the value of my home. I paid down that much. And so now I do a reverse mortgage on this home. Mm-hmm. Is Bank of America the ones giving me the reverse mortgage, or nope. Is it a third party that's giving me the reverse mortgage? And because I am no longer making any mortgage payments, what happens to Bank of America? It was like, hey man, I was making good money every month, and now this guy's he's not paying me anymore.
Yeah, exactly, Doug. Let's clarify that. When I did my reverse mortgage, I had a loan with Chase. Okay, so I owed Chase $430,000. Chase requires me to make payments for another 30 years or 28 years, whatever was left on my mortgage. But I used the reverse, and the reverse mortgage has to be in first position. So I used the reverse mortgage to pay Chase off, and there was still 30 grand left, and I took the rest out. So Chase is out of the picture. Fairway is who I owe the money to now. And Fairway has a reverse loan that I don't have to pay off until I'm 150. It's
okay, so they pay off the mortgage.
Right.
I refinance from a forward to a reverse. because Bank of America and Chase do not have reverse mortgages. So I went to Fairway, the company I work for, paid them off, and now I have an optional payment mortgage.
Got it.
But I planned to do that from the time I took out my first mortgage. So I knew what I was going to do with that. I wasn't going to pay for it for 30 years. I was going to get rid of it after 2 because I was 60 when I took out that loan to buy this property. And then from there is when I put that together.
Got it.
You know, Peggy is an absolutely awesome, delightful host. And what I'd like, it's a nice small group here. I'll give you my, in the chat box, I'll give you my email. And I wrote a book on reverse mortgages, very simple book, 90 pages. And what I will do, if you send me your address, I will send you a free copy of the book. You can buy it on Amazon for $20, or you can get it from me for free. So
what they could do is they could let me know, and then I'll send that to you.
Perfect. That would be awesome. Yes. Then you don't have to worry
So
about
just
it.
say, if you want the book, go into the chat, each person, and say, I want the book, and I will send that, because I think I have pretty much all of your addresses. If I don't, I'll send you an email saying you got to give me your mailing address. Okay. All right. So Harlan, amazing. Thank you very much. As usual, people just thought this was a terrific and had lots and lots and lots of questions. So thank you. And I hope you will come back again, because this is a subject people, obviously, that includes myself, had a different attitude until you did this presentation.
Mhm.
So thank you for coming.
Well, thank you. I enjoyed it. Everybody have a happy Thanksgiving. Appreciate you guys listening. A lot of people, when I talk about reverse mortgages, they walk out of the room. I had a lady in Atlanta, and she said, hey, I understand you're speaking about reverse mortgages at 2:00 during the program at the conference. And I said, yeah, I'm looking forward to having you coming. She said, actually, I took that one, and that's when I'm going to do my emails. I don't need to know anything about reverse mortgages because I don't like them. And so I won't be at your meeting. And I said, oh, just a minute, you're hurting my feelings here, but you're going to be a lot better off if you come to the session. And she did, and she learned a lot. So thank all of you for not hanging up and hearing about reverse mortgages.
You're very welcome.